Hello everyone, and welcome to this presentation of the three main components of a winning strategy. Welcome, my name is Stephen Primo. I am the president and founder of Specialist Trading, and our philosophy behind Specialist Trading is to educate traders so that you can ultimately make your own trading decisions. We feel it's our philosophy basically that the reason why most traders fail is because you're taking yourself out of the game. You're relying on either someone or something to tell you when to trade, how to trade, what market to trade, what's the perfect time frame to trade. And we really feel this is a recipe for a disaster. So what we do is we provide all of our students with the tips, techniques, and strategies that I've accumulated in my trading career so that ultimately you can empower yourself with this information and go on to make your own trading decisions, ultimately becoming successful in terms of consistency. Now, once again, my name is Stephen Primo. I have been trading for a total of 38 years. I started my trading career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist. The specialists were those gentlemen that made markets in roughly about anywhere from 35 to 50 stocks. So I made markets during the crash of 1987 and the bull market that followed. And I've seen and traded through just about every market environment, every trading technique, every system. So I know what works in terms of consistency and I know what doesn't. And this is why I started Specialist Trading. I teamed up with Pro Trader Strategies roughly about 7 years ago. And all I do is educate and mentor my students and members the things that I currently use myself, all the things that I've accumulated in my 38-year career, and all the things that I really believe have a certain amount of consistency. So this is what we're going to be teaching you today. Hopefully you can take these three components and apply them either to your current strategy, or you can devise a strategy based off of these things I'm going to be teaching you today. And hopefully you can start out 2016 getting finally on that road to consistency. I know you've been searching for consistency in your trading, and that's our goal, to get you on that road or on that path to consistency. Now, as I stated, I'm going to be sharing these three main components with you today. But before we begin, I ask that you please take a moment to view our disclaimer. We are required to show you this, so please take a moment to view it. I'm going to show you a lot of performance results. I'm going to teach you what to look for and how to identify these three main components. But please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So we're required to show you this disclaimer. So as you're taking a moment to view it, I would also like to invite each and every one of you, if you haven't done so already, to follow us on Twitter. There is our handle right there. It's abbreviation for Specialist Trading. It's at SPCLST. TRADG. I post free information on a daily basis, anywhere from daily financial wisdom, as I'm sure a lot of you have seen. We've gotten a lot of nice comments on my financial wisdom little tidbits, to actual signals that our strategies have generated. So there's a lot of great free information on a daily basis posted there. The only problem with Twitter is that it's very limited because of the way it is formatted on Twitter. So if you'd like to get more detailed information, such as videos or a lot more about what we do, how we teach, and myself exactly, you can go to our Facebook page. Pro Trader Strategies has put together a Facebook page. So there's a lot of information there as well that's a little bit more detailed, a little bit more knowledgeable about myself and about what we do. Okay, so as I stated in the very opening sentence of this presentation, we are first and foremost an educational company. It really is our belief that if you rely on someone or something to tell you what to trade, if you rely on a signal with no information and no basis for it, just to take the trade because you trust some guru or some indicator, you're really setting yourself up for failure, because it's really a recipe for disaster to take yourself out of the game. The only problem is most traders do that, myself included. When I first started trading, I was like 99.9% of all the traders. I wanted either some indicator or some guru to tell me what to trade, how to trade. And I read all the books, I went to all the seminars, I had all the periodicals and all the newsletters. And guess what? I couldn't make a dime. Even though I was on the floor and I had access to privy information and all the information about what the book was doing in the institutions, I still couldn't make a dime. So my mentors taught me that, Steve, to open up my eyes and see that that's not the road to consistency. The road to consistency is really based in simplicity. It's stripping away all of this, what they call noise, and learning just to listen to the market. So that's our goal. We want to listen to what the market is telling us. not to what some outside source, such as an indicator or some trading guru on TV is saying, but what the market is telling us. And therefore, if you only listen to the market, it's a lot simpler. You don't have to have all this, tons of indicators and follow all these news events and everything on your screen. You just have to need and know how to look at the chart in front of you. This is the edge that was able to turn my trading around, that has been able to sustain me for 38 years. And this is what I teach all my students. The same edge that sustained me is the same edge I want to teach my students. That's the specialist edge. Okay, as you notice here, I say my goal is to teach you, not to trade for you. Even though we provide all our members with signals and information on these strategies, they're more as guidance tools or educational tools so that ultimately you'll know what to identify on your own. Okay, so here's what you're going to learn today. Now, before we begin, I know a lot of you may have questions during the presentation. If you do have a question, please wait till the very end to ask any questions. So I have a lot of great information to give you, but if we stop for every 5 minutes when there's a question, we may be here for a couple of hours. So I don't want to do that. And oftentimes, if you wait for the next slide, your question is answered. If you're having technical difficulties, I'll answer that. Sometimes the best thing to do, if you can't hear or see the screen correctly, is just to log off and then to log back on. If you have to leave early, or if you have too many technical difficulties, it's not working, we will provide a link to a recording of this. You just go to Pro Trader Strategies, and they will have a link for the recording. Okay. All right, so why don't we begin? And here is what you're going to be learning today. Since this is a class and I'm going to be teaching you as one of my students today, I'm going to teach you component number 1, which is a very simple but powerful way to trade in sync with the market. Component number 2 is a specific price bar pattern that you should be looking for in any trading technique that you're using. It doesn't have to be one of mine, it could be anything you're currently using, because it is a signal coming from the market. And then component number 3, we're going to share with you an entry technique. This is a great entry technique that we really feel will increase your odds for consistency. And then lastly, we'll put all these together, and then we'll show you how to increase your odds for consistency even more. So you're going to learn a lot today. Once again, you can apply these 3 components to either your current strategy, or you can build and devise a strategy based off of them. That's how important and how powerful they are. All right, why don't we begin? Starting off, obviously, with component number 1, and that is you must trade in sync with the trend. Everyone knows this. As I always say to my students, this is Trading 101. We have new students that have been trading for years, and they say, well, Steve, this is it. This is component number 1. I learned that 10 years ago. Here's the problem. Everyone knows you have to be in sync with the trend. But if everyone knows this, why do the majority of traders fail? It's because everyone has a different idea of what the trend is or how to find the trend. Every educator, every course teaches you a different way of what the trend is. And in my 38 years of trading, most of those techniques have no consistency to them. Let me show you what we mean here. Here is a generic chart. I specifically left off the market and the time frame because I don't want you to focus on that. All we're looking at is what the market is telling us, the price bars. Now, someone just looking at this who is not a member of any of our courses or my teaching would say, well, Steve, there is no trend here because basically we're just going down, then back up, and then back down again. So I've always been taught that's a rangy market, and rangy markets are where you lose the most money. So that's what you should stay out of, okay? So most people would say there's no trend here. That's not true the way we teach our students at Specialist Trading, because the way we find out what trend is by simply adding a 50-period moving average. All right, and it doesn't matter if this is a 5-minute chart, it doesn't matter if it's a monthly or a weekly chart. It absolutely makes no difference what the market is, but you should always have a 50-period moving average plotted on any chart. And then ask yourself, where is price in relation to that? If the majority of price is above, or if you are entering into a trade and it's above, well then that trend is obviously up. Okay, if the overall trend is up, what does that mean? Does that mean, okay, well, I guess I should just buy at the market? No, it just means that from now on, any signals you get should only be buy signals. Regardless if it's my strategy or one of your strategies, you should only be taking buy signals if you are in an overall trend, meaning if price is above the 50-period moving average. I know it seems simple, but you will increase your odds for success tremendously if you apply this simple trend identifying tool. Same with this generic example here. Once again, does not matter what market, does not matter what time frame. Obviously, someone looking at this would say, well, Steve, no trend at all. Once again, we're just in a range. It's a whipsaw market. I'm not going to do anything. There's no trend here. Not true. At specialist trading, we always apply a 50-period moving average, and then we always ask ourselves, where is price in relation to that 50-period moving average? Okay, obviously, price is below, right? So if price is below, then that's telling us the overall trend is down. All right, now, so what does that mean? The overall trend is down. And how do we go from there? Well, if the overall trend is down, you are only going to be a seller. You will absolutely never buy if price is below the 50. You will never get a buy setup. I don't care if someone tells you the market is bottoming, that this is the lowest we've ever been, we've got to buy it. If you are below the 50, you are not a buyer in any strategy. Trust me, over 38 years, I have learned that this simple tool will increase your odds for consistency tremendously if you just apply it with any market and in any time frame. All right, so that was component number one. Let's go to component number two. Now that we know what the overall trend is, we want to look for bars that close either in the top or bottom 25% of their range. All right, so what exactly does that mean? A lot of students have difficulty with this. All right, let's say you have a bar here like this, and it would not matter if this was a candlestick. It doesn't matter if it's an open, high, low, close bar. It absolutely makes no difference. But the range is from extreme high to extreme low. It's not from open to close. For some reason, a lot of students think that is what the range is. It's been convoluted along the way, along the years, but the range is top to bottom, okay? Could be the top of the wick, could be the bottom of the wick, doesn't matter what chart you're looking at. But what you want to do is now, once you know what the range is, the extreme high, the extreme low, divide by 4 separate but equal parts. And if you close in that top 25%, and if the bar is above the 50-period moving average, well, the market is giving you a tremendous indication to buy. You see now how we're taking all of our cues from the market. We're not taking any cues from, well, now that some guy on TV is now telling us to buy. We don't care about that because these guys most of the time are not even right. There's no consistency. But there is tremendous consistency when the market tells you what it wants to do. Now, conversely, if we look at the chart here, we are above the 50-period moving average. And these are the 3 bars that closed in the top 25% of their range, okay? Let's look at the other side of the coin. We have a bar here that closes towards the bottom of its range. I know it's easy to spot here, but remember the formula is just divide by 4. If you close in that bottom 25%, not some guy on TV, not some other convoluted indicator, not some chat room, but the market, the most important thing you should be listening to, in fact, the only thing you should be listening to, the market is telling you, if you see this, that you close in the bottom 25% and you are below the 50-period moving average, it's indicating that you should be selling or that a drop in price will soon be coming. All right, that's how easy it is. And if we look at that generic chart again, price is below the 50. Here's the bar that closed in the bottom 25% of its range. All right, so now that we've got component number 1 and component number 2, how do we enter based off the information we've just given you? Well, we want to apply our confirmation technique. This is, you want to enter upon the confirmation of trend. Now, what does that mean exactly? Well, here is the confirmation method if you are buying. Meaning that once you get a setup, and it doesn't have to be the setup based off what I just taught you. It could be a setup based off anything you're using, because remember, this is an entry technique that you can apply to any strategy. But if you get a buy setup, you're not going to buy at the market. You're not going to place a limit, a lower limit order. But what you want to do is buy if price trades 1 to 5 ticks above the bar that closed in the top 25% of its range. All right? This will greatly increase your odds for success. So if we look right here, these are the 3 bars that closed in the top of their range. All right? So if we look at the first example, this is where we want to buy. Now, if we want to increase our odds even greater, we only want to buy on the next bar because we're trying to catch momentum. So if we see here on the very next bar, we never traded up there. So there was no setup. There was no trigger. All right? So we're just kind of waiting on the sidelines for another bar to close in its top 25%. And here's where we want to buy if we trade above there. And we've got to trade above there on the next bar only because we're trying to catch momentum. All right, so it did trade there. Doesn't have to close there, just has to trade there. So that's our entry point, and we went up for the next 3 to 5 bars, okay? Now, I know it doesn't look like a lot, but how do we know these aren't monthly bars? How do we know that the price, those are not 5 points each and you gain 20 points? All right, it's all relative. And then lastly, we have another setup here. All right, we close in the top 25%. Our entry technique tells us that we only want to enter if we trade above that dotted green line on the next bar only. And we only have to trade there. Remember, we do not have to close there. As you can see, we trade there. We've entered into the trade, and, well, this time it went up a little higher. You see, all these positive trades were based off of one thing: learning how to listen to the market. We didn't base it off of any news. We didn't go to any chat room or trading room and listen to what people were saying. We weren't watching TV or looking at earnings report or waiting for a news report on what earnings were going to tell us. The market most likely tells you everything you need to know in advance. There's no reason to waste your time and try and discern what everything means. And especially, there's no reason to spend a lot of money on all these high convoluted programs. Now let's look at the other side of the coin if we're selling. All right, the confirmation method to go short simply says we're going to sell if price trades 1 to 5 ticks below the bar that closed in the bottom 25% of its range. So if we look at this generic chart, once again, we are below the 50. The bar in red closed in the bottom 25% of its range. So this means we want to sell using our confirmation entry, not at the market, not placing a limit somewhere higher up here, but only if we trade at this level and on the next bar. All right? Wouldn't matter if this was a tick chart. It wouldn't matter if this was a monthly bar. The same thing applies to all time frames, all markets. So let's see what the next bar did. Well, yes, it traded there. In fact, it traded there and then closed higher. So do we exit the trade? No, we do not care where it closes. All that we care is that it traded there. So we enter into the trade to go short, and look what happens. Once again, all of our information came from the most important source. That's the chart in front of you. Now, I've just given you 3 extremely important components that I feel extremely positive about and confident that if you add them to any strategy you're currently using, you will greatly enhance your odds for success in terms of consistency. And if you've got enough experience and if you are so inclined, you can base and build a strategy based off of what I've just shared with you, okay? But let me tell you, what I just did at the same time was give you 3 of the rules to probably one of our most consistent strategies and most popular strategies. That's strategy number 4. Okay, let me just share with you some of the highlights behind this particular strategy. Now, it's for virtually all traders. Okay, all traders, meaning that it does not matter if you started trading yesterday, or it does not matter if you trade a hedge fund, which many of our members do. Everyone is going to be getting the same rules. So it does not matter in terms of your experience level or how long or how much you know about the market. Everyone gets the same basic format. Okay. Now, once again, if you happen to come in late, we're only going to be taking questions at the very end of the presentation. So there's a box I have to open up in order to answer questions. So it would not even matter if you asked a question. I won't be seeing it until the next 20 or 30 minutes. So kindly wait to questions at the very end. All right. So this particular strategy was taught to me when I was on the floor some 38 years ago on the Pacific Stock Exchange. And this is one of the strategies that changed my trading completely. This is what got me on the road to consistency, just one of the many that I've learned along the way. So when I learned this on the floor, we were usually holding positions anywhere from a couple of minutes to maybe 10 minutes at a time. So it was originally designed for traders looking to catch quick momentum moves because we were on the floor being in and out of trades in a matter of moments. But as a member of the course, we not only teach you how to get in and out quickly, so it's not just for day traders, we also show you how to stay in the trade much longer if you would like. This is the mentoring, and this is the information I provide for my 38 years of experience that I give you in the course. So you don't have to trade it just to be in and out in a matter of moments. Now, its intensity level from 1 to 3, if 1 was the most intense of all strategies you've ever seen, meaning that you literally could not even go to the bathroom, walk away from your computer. You had to be glued in front of it 24/7. And 3 was the most relaxed of all strategies. You basically just entered an order and walked away and came back a week later to see what was happening. It's right in the middle. It's a very moderate number 2, okay, type intensity level. It only uses one indicator. That shows you how moderate it is. And guess what? You already know what that is. It's the 50-period moving average. All right, so you don't even have to worry about tons of indicators. You don't have to look at news events. You don't have to look at the full moon. It's very, very simple and basic to understand. It works in any time frame, any direction, and any market. Now, for educational purposes only, members receive automatic buy and sell indication. I'll show you some of these where they come at either buy arrows and sell arrows, or just red or green dot indications depending on what software package you have. But we give you indications only for educational purposes, though, so that you can check your work to see if you have properly and identified a valid setup. Now, our edge here is consistency. I'm not like most educational presenters that say, oh, if you try this, you will be up 1,000% by this time next year, or you will be on that dream vacation or buying your house. I don't believe in that. In fact, I think if you hear that from anyone, you should run, because all these successful traders I know trade 2 steps forward, 1 step back. In other words, it's perfectly natural to have small losses from time to time. There's nothing wrong with that. Okay, but the point of having a consistent strategy is the ability to recoup those losses, whether they're small or major or whatever, or just moderate. The point is you want to be able to have a strategy that takes you 2 steps forward, 1 step back, 2 steps forward, 1 step back. The only problem is with most other strategies or systems, they usually take you 1 giant step forward where you feel fantastic, you can make a lot of money, and then the remainder of the next 5, 10, 20 steps are backwards, and you give it all back. There's no consistency in that type of trading. So what we do is provide you with strategies and techniques that have stood the test of time, that are extremely consistent, that will have losses from time to time. It's perfectly normal, but have a high level of consistency that has the ability to make it back very soon. All right, so let me show you some of these examples. And remember, you just learned 3 of the 5 rules of this particular strategy. I know a lot of you will be asking me, well, what are the other rules? That would be comparable to getting a free appetizer at a restaurant and then saying, can you throw in the dinner for free too? I mean, it wouldn't be fair to the restaurant owner who just gave you a free, appetizer entree. So it's the same with us. We are a business. We're trying to educate you, but at the same time, we'd like to be reciprocated for the 38 years experience we're giving you. All right, so let's look at this older chart. We're going to start out with some older charts for educational purposes. Then we'll show you charts that happened just as recent as yesterday. Here's a chart in MSI. As we see here, coming into this, we were below the 50 period, but then we crossed above it. All right, so for all intents and purposes, we are in the overall uptrend. So we are not even going to consider selling anything because price is above the 50 period moving average. I know you may be seeing some terrible news on this stock, or you may be hearing someone in the markets talking in the chat room telling you you've got to sell everything. Don't listen to those things. There's no consistency. The market is most likely telling you what it's going to be doing. So now that we're above the 50-period moving average, we find a bar here that closes in its top 25%, and the add-on for the charting software generates a buy signal. So we know that we can't simply buy here. We have to use component number 3 and buy once we trade above. Okay? So if we see what happened the very next day, well, we did trade above there, and you would have made a nice 7 or 8 points in the next month. Okay, see how simple this was? Why? Because we're above the 50. We have the market telling us, according to this bar here, we close in the top 25% that it wants to go higher. And we used our entry technique because obviously we could have opened and then gone straight lower. So we want to use the confirmation. Now remember, you're going to see bars here that close in the top 25%, this one here too, but they did not meet the remaining rules and requirements of the strategy. That's why no strategy signal was generated. Now the same thing works to the downside. This older chart in WYN, we ask ourselves, where is price in relation to the 50-period moving average? Price is below. So are we going to be buying anything? No, we're going to be sellers. Doesn't matter what anyone says Over time, you will have more consistency if you sell below the 50 as opposed to buying. So we have a bar here that closes in its bottom quarter of its range, and the strategy software generated a sell signal. Now we can't just sell at the market. We don't want to put a limit somewhere up here. We want to only sell if we confirm on the next day that we're going lower. Well, we did. In fact, we gapped a lot lower. We gapped about a point lower, but a lot of our students don't mind. They set themselves a limit of anywhere from a point to 2 points where they'll get into the trade. And it would have been a good trade had you even entered short in a point lower, because the stock went down roughly another 7 points. Now, we're talking about consistency, all right? You will see these techniques work. Go out and experiment for yourself. You've seen the 3 components. I've taught them to you, all right? So go back and do your due diligence and research. You'll see the consistency in this. But remember, consistency means 2 steps forward, 1 step back. As in this example of Tesla, we see here that we are below the 50-period moving average. A sell signal was generated here. We have a valid signal to go short if we trade the next day here, and it did, but look what happened, okay? This was a losing trade. So we have to ask ourselves, how can we increase our odds for success? Because even though we have a very high level of consistency rate just by applying strategy number 4 by itself, how can we increase our rate of consistency even more? All right, as traders, we're always trying to be better. We're trying to filter out losing trades. And we have found something through our research and through our trading and also through our members who have given us feedback. And this is by applying our PET D. I'm sure you've heard me speak of this before. If you've attended any of my webinars, you know that Strategy 4 and PET D are probably our 2 most popular techniques, and the techniques that I use myself on a consistent basis, daily basis. So what is the PET D? The PET D is simply a proprietary. By proprietary, I mean it's based off momentum. That's the only information I can give you. We're keeping the formula in-house, but it's a proprietary algorithm that I was taught over 30 years ago on the floor of the exchange that is probably the best thing I know of for telling me what the short-term trend is. Now remember, we told you what the overall trend is by applying the 50-period moving average. It's simple enough. Anyone can do that. But for the short-term trend, all right, for seeing the trend within the trend, the PET D works better than anything I've come across in 38 years. So if you see a series of green bars, the PET D is telling you that the short-term trend is up. If you see a series of red bars, obviously the short-term trend is down. It's that simple. We have it all figured out for you. All you have to do is upload the PET D, and it automatically colors your bars either green or red. It doesn't repaint. You know, if you go forward, you don't look back a couple of days later and say, hey, that bar used to be green, now it's red. Once the bar closes, that's the color. It stays the color. Let me show you how we're going to use it with strategy 4 to increase our odds for success. If strategy number 4 generates a buy signal based off the 3 rules I just shared with you, then the PET D must color that bar that closed in the top 25% green. Conversely, if strategy number 4 generates a sell signal based off the 3 components I just taught you, well then the PET D must color that bar that closes in its bottom 25% red. Okay, this gives you that added level of consistency, and you will have that added level of assurance and confidence to take the trade. So let's look at some more recent examples now, applying this, the strategy number 4, with the PET D, and we'll show you how you can increase your odds for success even more. All right, here's an older chart in Oracle. By older, I mean going back to last couple of months. Now, as we see here, we are initially below the 50, we cross back above, we're below it, we're above. So right here, it's a little bit more complicated, a little bit more advanced way to trade. Having said that though, the software automatically generated a buy signal at the end of October to go long. All right, we're above the 50-period moving average, we closed above, and we closed in the top 25%. So having seen that we're above, below, how do we know that this is just not going to trade a little above and then go right back lower the way it has been? All right, we're a little bit frightened to take this trade. Maybe you want a little bit more confidence in taking it. Well, the way to do that is to apply the PET D. Remember, if you get a buy setup, you want that bar to be colored green. So we apply the PET D, and as you can see, it colored the bar green. It's telling you it is in sync with the short-term trend. Had it colored the bar red, it was telling you it's in sync with the short-term downtrend. So you don't want to buy if you're in a short-term downtrend. So therefore, you have the confidence to take this trade, and Oracle gained 7% in 2 weeks. How about IBM? This is just about a month ago. We're below the 50 period. We have a bar that closed in its bottom 25% of its range. It meets all the other requirements, so the add-on software generated a sell signal on the 4th. Okay? But once again, let's say you're still not over your addiction to news. Say there's some news that's supposed to come out. Say you're frightened because some guy you listen to on TV says IBM should be bought. You're conflicted, you're a little scared, maybe even your last trade didn't work out that well using strategy number 4. Remember, there's going to be losses from time to time. So you're a little scared, you don't have much confidence in this setup. So what do? You add the pet D. And in order to take this trade, it must be colored red. So we add the pet D, and we see that this entire time, all of the bars, even when we had this bounce up, the bars were red. Even since 2 prior weeks before, we were bouncing up higher, the bars remained red. So obviously, IBM overall trend is down, and the short-term trend is down. So they're both in sync with each other. You have confidence to take this trade, and the stock dropped 10 points in a little over a week. Now we realize it's expensive stock, but you could have purchased puts on this, directional option. A lot of our traders don't actually buy the stock or short the stock. What they do is they simply get the signal and they just apply a call or directional put. How about Pepsi? Okay, here's once again going back to October and November of last month. There are 2 signals here, 2 buy signals. Obviously the first one worked out very nicely, but how do we know the second one's going to work out? Okay, well, we add the pet D. And as we can see, the pet D colored this bar green. If you look back even here in hindsight, we see that the pet D, being a short-term tool, was coloring the bars green even before it was above the 50. This is how advanced and this is how fine-tuned the pet D is. All right? Remember, the 50 period will give you the overall trend, but the pet D is really sensitive, fine-tuned for the short-term trend. So even, a good 10 points lower, it was already telling you Pepsi is in an uptrend. So a strategy 4 signal was generated on the 15th of October, and you would have taken that one and gained about 4 points in a week. Now here's another one on the 3rd, just about a month ago. Would we have taken this signal? No. Why? Because in order to take a buy signal, the bar needs to be colored green by the pet D. And what color was it colored by the pet D? It's colored red. All right, so we do not take those bars to buy if they're colored red. And it was a good thing we didn't, because it would have resulted in a losing trade. So do you see how the pet D is increasing our odds for consistency because it's acting as a filter to keep us out of a lot of bad trades? Sure, every once in a while it will get you in a trade that is in sync with both the overall and the pet D, but we've decreased our odds for those significantly. Let's look at FOSL. As we see here, going all the way back September into November, we have a number of sell trades, and they all worked out. All right, generated. These are just strategy number 4 sell signals generated by themselves. And if we apply the pet D, we see that each and every one of them was a confirmed signal to go short using the pet D. Now, if you're a very short-term trader, you could have taken each and every one of these and gotten in and out rather quickly. Okay. Or if you wanted to go in for the long haul, you could have said, well, you know what, I like, Steve, I'm sorry, but I like to look at fundamental news, and I don't like this stock as well, and your tools are telling me to sell it, so I feel confident about this along with the pet D. So let's say you want to stay in this for the long haul. Well, we show you ways how you could stay in much longer, and that way you would have gained 27 points on this sell-off. Now, as we see here, there obviously was some news that came out where the stock dropped, a good 20 points or so. No one in the company told us ahead of time that the stock was going to gap down. We took all of our signals, all of our setups from the only thing that we focus on, the chart in front of us. All right, let's apply this to the EMini. All right, now usually people that trade the EMini are intraday traders. I'm going to start out by sharing with you an older chart for, once again, for purposes just to show you the consistency rate in this in any market and or time frame. We're going to go back all the way to August. All right. Now this is August of this year. We all remember what happened in August, but prior to that large sell-off, we had a buy signal that was generated. Now this was a little difficult. Once again, it's a little bit more advanced setup because we're oscillating above and below the 50 period. Now on the 10th of August, a buy signal was generated. All right, it met all the rules. And let's say we had taken that trade. Well, we want to make sure it's verified. And guess what? The PET D verified it. It colored the bar green. But this is what I'm talking about. You will still find losses from time to time, even with the PET D. All right, as we see here, you would have entered the trade and you would have most likely been stopped out. Okay, and the next week we did the same thing. We're in a range oscillating above and below. So as you can see, we continue to go higher and lower, even though we had a losing trade here. But now on this date, the 19th of August, another signal was generated, a signal to go short, and it is below the 50 and it's colored red. So this is what we talk about consistency. Consistency means 2 steps forward, 1 step back. And the beauty of applying strategy 4 with the PET D is when you have those losses from time to time, you're able to make it back rather quickly. So we would have taken a loss on the 10th of August, but a week or two later, guess what? 230 points came our way, taking the second signal. Now we're not saying that every one of our students held out for the remaining 4 days here to generate 230 points or roughly $12,000. But you see here the consistency in this and how strong these techniques are. Now that's on a daily bar. Let's go to a smaller time frame, just about a month ago on a 60-minute chart. As we see here, price was originally above the 50-period moving average. It generated a buy signal. And this signal, I don't know, if you had been very quick, you could have taken a quick gain off this, but most likely you would have been stopped out. But then it was followed by 3 winning trades, okay? So how would we have done had we applied the PET D? Well, we simply apply the color bar tool, and we see here that the first buy signal was colored red, so we never would have taken this trade. We only would have taken the next 3, which were all colored red by the PET D, and 50 points in roughly about 3 or 4 days to the downside. That's $2,500 per contract. Now let's lastly move on to the Forex markets for all you currency pair traders, just to show you that this works in any market and in any time frame. Here's a weekly chart of the Canadian dollar. We are above the 50-period moving average. The software generated 2 buy signals. This first one resulted most likely in a loss. The second one would have worked well. If we applied the 50-period, or I should say if we applied the PET D, we see that there was no signal here in the first place because it's colored red. But this one is a valid signal, and 1,100 pips in the next month. That's roughly about $11,000. This is a weekly chart of the Canadian dollar. And the good thing about strategy 4 is that oftentimes, if you miss the first setup, you're given a second chance to get in. Even if the gains aren't as much, you still get more than one chance. You never have to feel like you've missed anything. Here's a monthly chart. Okay, we've looked at weekly, daily, intraday charts. We're now looking at monthly charts. We are below the 50-period moving average in the Australian dollar. All right, we have a sell signal here. But how do we know we should be selling on a monthly time frame? Let's just say we're long-term investors in currency pairs. Some of you may say, well, Steve, this looks like a double bottom here. All of my indicators say that we have, even though we made lower lows as opposed to this low, well, we have some type of non-confirmation with another tool. The retracement didn't meet and didn't match. So, this is actually a buy signal. So why would I want to sell? Well, we don't look at those things. Remember, there's no consistency in looking at a lot of retracements and looking at Fibonacci levels and looking at support and resistance because they're mostly subjective. One trader's support is another trader's resistance. We don't care what the institutions are doing. We don't care what volume is doing. We only look at a few simple patterns that tell us what the market is doing. And the market was telling us, based off of these patterns that we share with you today and based off the remaining rules of strategy 4, that it wants to go lower. Now, the other tool we're applying is the PET D, and the PET D is simply a translator. It's translating what the market wants to tell us on a more sensitive time frame. And it's telling us that if we color the bars, it's red. In fact, we've been red even when we were above the 50-period moving average. This entire time, we've been in a short-term downtrend. We had one green bar, but we quickly went back to red, and it verified the sell signal. So as a translating tool, the PET D is saying we are going lower. Don't listen to what anyone says. Don't listen to any fundamental news or what's going on in the world. On a monthly basis, the Australian dollar is telling you, I want to go lower. So our job is simply to listen to the market, whatever we're trading, and to jump on board. So all we had to do is jump on board by adding our rules for the strategy and Look what happened coming into September, October of this year. That's 2,300 pips, or $23,000 we had to work with in our direction. All right, so let's recap before we go to any questions and answers that you may have. Here's what you learned today. All right, you can start applying this right away. We ask that you, first of all, that you do a little research and study first, paper trade, just so that you get these components under your belt. But you can apply them to your current trading strategy, or you can build a strategy based off of these. That's how powerful they are, but how simple they are as well. All right, component number 1, 2, and 3. We share with you how to trade in sync with the market. The simplest but most powerful way we know is to just add a 50-period moving average. That gives you the overall market. That's all you have to do. If price is above, then the overall trend is up. Do we just stop there? No. If the overall trend is up, then we're only going to be buyers. All right. If price is below, the overall trend is down. If the overall trend is down, are we going to buy anything? No, we are only going to be sellers. I can almost guarantee that if you look back at your last 10 or 20 trades, the reason why you lost on some trades was because you were out of sync with the simple rule. Go back and look at your last 10 or 20 trades. Most of the time, what traders do is the opposite. They're selling above the 50 period and buying below the 50 period. Do the opposite and you will greatly increase your odds for consistency. Component number 2, the price bar pattern. We want to listen to what the market is telling us. When the market closes in the top 25% of its range, and when it's above the 50 period, it is screaming that it's most likely going to be going higher for the next 3 to 5 bars. Okay? If we are below the 50 and we close in the bottom 25%, the market is trying to tell us most likely it's going lower. All right? So you want to find that and look for bars like that. But you just don't want to enter at the market. You want to use this entry technique. Whenever you get any type of setup, it doesn't have to be this, it can be any strategy. Don't buy at the market. Don't place a limit order lower or below. Wait for price to trade 1 to 5 ticks above if you're buying, and that's your entry point, just to confirm that you're going in the desired direction. Or if you're selling, wait for price to trade 1 to 5 ticks below that setup bar, okay, before you enter. Just imagine this scenario. If you're at a train station and you want to get from point A to point B, and you're waiting for your train to arrive, all right? And you see a train coming down the tracks, but it's going in the opposite direction of where you want to go. Are you going to jump on that train? No, because it's not going in the direction you want to be going. So most likely it's not going to be going in your destination. Now you see a train that is coming down the tracks that is going in your desired direction. That's the one you want to jump on, because that's the one that is going in your direction of your destination. It's the same way with this entry technique. If you are buying, you only want to jump on board if you see price going in that direction. Okay? Now these are 3 great components. Once again, you know all these. Go back and do your research and see how well they can apply to any of your trading, or if you want to base any strategies based off of them. But we showed you how they make up one of our most popular strategies, strategy number 4. And then when we apply the pet D to that strategy, we increase our odds for success even more. So we've shown you how to increase your odds for success, starting out with these 3 main components and then just adding 2 of our most popular and most consistent techniques, the strategy number 4 and the pet D. In fact, they are so popular and have done so well for so many traders, whether they're hedge fund traders or whether they're just people that first started trading just a matter of weeks ago, that we call them our dynamic duo, because they work so well in unison together. The strategy number 4 has a high level of consistency in generating buy and sell setups. And then when you apply the pet D, it increases your odds for consistency even more. That's why we call it our dynamic duo. So in closing today, here's the special we have for all the attendees. Remember, we're at the end of 2015. Are you anywhere near where you thought you'd be at the beginning of 2015? I can almost say that probably none of you are, because this is the way most traders are. We start at the beginning of the year with all these hopes and dreams, and most of us never reach those aims, because I used to be there myself. All right, but here's a way to get back on track for 2016. We're offering you our dynamic duo end of year special. It's strategy number 4 along with the pet D. All right, this is our dynamic duo. We're offering you all of this for a great discount. Let me show you part of what you're going to be receiving here. Firstly, you're going to be getting signals, okay, signal alerts. And here's how you'll get them. Here's a few examples that just happened very recently. Here's an email alert that was generated on the 4th of December. All right, it's for a sell side, and as we see here, WRK generated a sell signal. We furnish you with all the information for educational purposes, and this was a strategy number 4 sell signal. If we look at the stock here, well, here was the date the sell signal was generated. All right, now a lot of people would say, well, gosh, I'm a new student here. It looks like we made a bottom right here, and the market is really strong. How can I be selling? You know, I just don't feel comfortable. Well, with the PET D, it gives you that added assurance, because if a sell signal is colored red the way it was here, that would have given you the confidence to take the trade. And as we see, the stock went down 7 points in the next couple of weeks. That was an actual signal generated with the dynamic duo. Now, even more recent, this was on the 14th, which was just this Monday. As we see here, these are buy signals where you get the email alerts, and here's one in PSA, strategy number 4, all right? So as we see here, someone looking at this would say, well, boy, Steve, this is a really expensive stock. I can't purchase something like this. Plus, it looks like it's rolled over, and I'm just kind of, very, weary of getting involved in an expensive stock, especially one that looks like it's rolling over and going lower. I don't trust the market. The market doesn't feel good to me. How do I know whether I should take this? Well, first of all, we know that it's an expensive stock, but a good majority of our members trade options. So when they see a signal, they don't purchase the stock. They'll just purchase some calls or a strategy that is based on the stock going higher. But if you still don't have the confidence to take that trade, well, with our special we're offering you today, you would have the dynamic duo. You just simply add the PET D, and you see here that this entire time, going back a week or so, the bars have all been green, even when we have a down day on the candle charts. This is a down day, but the bar is colored green. So we all know that even when the market is down, we are in an uptrend in PSA. So it gave you the confidence to take this trade. And on the 15th, guess what? 8 points in one day. That could have been enough for a nice trade. You could have gotten in and out with 8 points, some calls, whatever you wanted to trade. That was an actual signal generated and posted for our students. So this is one of the things you will be receiving. You will be receiving email alerts in strategy number 4. And let me show you something that happened yesterday, because I know a lot of you will say, well, Steve, I don't really trade stocks, so that wouldn't really apply to me. I'm an intraday trader. Okay, well, here's an intraday trade of the EMini. This is the EMini on a 15-minute chart. This is starting just last Friday, coming into yesterday. In fact, this was this opening today. I took this morning before we started today's presentation. So we had coming into today a number of sell signals. These all worked out very nicely on a 15-minute time frame. But then we had 2 here generated on the 14th, which was Monday, that would have been losers. You would have been selling, and it would have gone up and stopped you out. You would have sold again and then been stopped out at the end of the day. So you had 2 losers, and then you had 2 more winners here. Okay, so this is without the PET D. This is just looking at strategy number 4. But how could we have increased our odds for success with our dynamic duo special? We simply add the PET D, and we see now that coming into this, all the sell signals were colored red, except these 2 on the 14th. They were colored green. So you would have never even taken these, because the PET D was telling you the short-term trend is most likely going higher. You would have bypassed these 2 losing trades and then had a winning trade at the beginning of the day yesterday, and then if you were inclined to carry the position overnight, had a really nice winning trade of 10 to 15 points on the opening today. Okay, so instead of having 1, 2, 3, 4, 5, 6, 7 trades with 2 losers, so 5 winning, 2 losing, you would have had a total of 5 winning trades, 3 sells and 2 buys, simply by using our dynamic duo. But we even go further than that. We can apply the PET D to long-term scenarios, because we know a lot of you like to trade your IRA portfolio. You like to trade your long-term portfolio for investing. So how can any of this be applied to a longer-term point of view? Well, let me share with you this monthly chart of the S&P index going back 20 years, back to 1995. We looked here all the way on the far left, okay? We see all the peaks and valleys of the S&P going back 20 years. We see when we first started rising, we have the .com crash that happened, and we fell out of bed in 2000, going down to 2003. Then price restored itself until we had the banking crisis in 2007 and 8, and we had another crash, And then we've been going up ever since, okay? But how do we know whether this is not going to be some type of a top and we're going to go much lower again into a bear market? Easy. You add the PET D, because the PET D is a great directional tool and it can be fine-tuned for whatever bar chart you're looking at. So we just simply apply the same PET D. And as you can see, the PET D can also identify long-term trends. Now, we're not looking for any entry points with the strategy, as in strategy number 4. We're just looking to identify the trend. And the rule of thumb is, whenever you see 3 consecutive bars of a different color, that's telling you that a trend change has taken place. So as we see all the way up from 1995 to 2000, the bars were green. Sure, we have maybe 1 or 2 red, but remember, we would need to see 3 red in order to tell us the trend had changed. Well, that didn't happen until right here. Sure, we didn't get out of the top, but in 2000, we had 3 red bars. You could have exited any of your long-term portfolio and bypassed all of the crash, the dot-com crash. Once you saw 3 consecutive green bars, you're back into the market in 2003. You would have ridden the entire bull market all the way up until the financial crisis in 2007. Right here, we had 3 red bars. Once again, we're not claiming to get you out at the extreme high, the very top, the very highest tick. We don't believe in that. We're just trying to be in sync with the market, listening to the market. Remember, the PET D translates what the market wants to do. The market speaks in a different language. The PET D translates it for us through a color bar algorithm. So therefore, when we had 3 red bars, the PET D was telling us that the market wants to go lower. You would have exited everything here in 2007 and bypassed this crash for the next 2 years. Once you had 3 green bars, you're back into the market again. And sure, every once in a while you had 2 or 1 red bars, but not enough to change trend. Now, in August and September, we had 2 red bars. We were getting very close to possibly getting an indication from the market that we're going lower, starting a bear market. But in October and November, we firmed back up again and are green. Wouldn't you like to know when we get 3 red bars again? You could bypass another 2, 3, possibly even 5 years of a bear market. That's what the PET D can do for you, okay? So if you really want to get back on board 2016, you see all the power you have using our dynamic duo in a number of ways, plus you get 38 years of experience as your personal mentor, lifetime correspondence with me, someone who's been trading these techniques for 38 years. You can always contact me, along with trading strategy number 4 and the PET D, our dynamic duo. Here's the end of year special. We're offering this for all the attendees today at a special discounted price of $14.95 plus a monthly small payment of $97, okay? Trust me, the PET D and the strategy 4 tools and strategies are so popular, the prices are probably going to be going up. So this is a great, great discounted price to get all this information, jam-packed trading techniques, things that I've been using in my own personal trading for roughly about 40 years, along with my personal mentoring experience to be with you every step of the way. So $14.95 and $97 per month for a limited time only. But as we stated, price may be going up along with that monthly payment. If you want to just get a full lifetime access to both courses where you would never have to pay any more and a one-time fee, it would be $29.95. So here's how to take advantage of this great deal. Contact my sister site, which is Pro Trader Strategies. They handle all of my marketing and promotion. You can email them at trading@protraderstrategies.com. Best thing would probably be to call them directly, and you can pick what type of format you want, what type of payment plan, 310-598-6677. We also have the link below, which is going to take you directly to the sign-up page, where all you have to do is simply click that on and you pay a one-time fee and it's yours for life, along with my personal correspondence. And that's not a live link. You have to copy and paste that onto your browser. So if you go onto your chat box on the far right, you see that they've posted a live link there. Simply click that on and it will automatically take you to that sign-up page. All right, so I'm going to leave this information. You really need to take advantage of this if you want to get your trading on track, if you want to be part of our dynamic duo course and be a personal student of mine. So I'm going to leave this information up here while I open up the question and answer page to take all your questions. And I want to thank you for holding off on asking any questions, okay? Let's see. Lorik says, brokers are hunting for the Brokers are hunting for all the setups, I believe, for an engulfing patterns. Well, Lorik, that's another course. That's an entirely different program we're offering today. Let's see. So I don't really know exactly what you're asking, but the engulfing pattern is a totally different course. It's a totally different setup than strategy number 4. So before we go into that, let's answer any questions that have to do with strategy 4 and the PET D. Brian says, in the next bar doesn't follow through, you wait for the next signal bar? Yes, Brian, if you're trading it with a basic format, remember we go into this in detail in the course and plus with any questions you may have. But if you're trading the standard basic format, you wait for price to trade on the next bar, either above or below that setup bar. If it does not, well, then you're out, the setup is negated and you wait for the next setup, okay? So you don't want to chase anything, because the beauty of what we just shared with you in these 3 components is, I'm sure Lorik and other people who have seen our presentations before, that we're trying to catch momentum. And momentum usually happens on the next bar. If it doesn't happen on the next bar, well, then we just wait for another setup, okay? Let's see, Craig is saying, can I get a recording? Yes, Craig, you can. Just go email, as you see here, or you can place a phone call into Pro Trader Strategies, and they will send you the link to this, okay? Frank asks, what does the PET D stand for? The PET D stands for the Primo Early Trend Detector, because when I was introduced to this, Frank, on the floor, it's a formula that I had to figure out by hand that my mentors taught me. And it was just based off momentum. That's the most information I can give you. But it was just, we knew it as the formula, okay? And so, it's just come up with this formula. And it's not extremely difficult, but it is a little, tedious to come up with. So it was not something you could be generating every 5 minutes if you were looking at 5-minute bars. It was something that we did at the end of every day to find out what the daily trend was. But now that we have high-speed computers and computer programmers, well, we're able to program it into a color bar algorithm. That's why we've changed the title to the PET D. Okay, I hope that explains it. Lorik is asking about which PET D time frame do I use? Well, Lorik, that's personally used, different for everyone. Remember, as I stated, Lorik, in the presentation opening, I said that we should never, the reason why most traders fail is because you're trying to mimic or copy or take your direction from another trader. So the most important question that most people think they're asking me is like, what's the best time frame to trade? Or what's the best market to trade? Or what is the best software to use? And I always say, and I try to answer by saying, listen, I'm not being arrogant or condescending, but the best one is the one that makes you feel comfortable. Because I can guarantee you, if you try to mimic what time frame I trade with or what market I trade with, you're going to lose money, because everyone has to approach the market using their own personality traits, their own, if you're a conservative trader and you're trying to trade aggressive like someone else, you're going to lose money. If you're an aggressive trader and the person you're listening to is conservative, you're going to lose money because you're out of sync with your own personal style. So when you're asking me what time frame I use, it changes. It's different. It changes on a day-to-day basis because sometimes I'm giving webinars all day like I am today. Other times I'm free. So it all depends. Therefore, do the research, find what works for you. That's the only way in my 38 years you will become consistent. That's why we say we provide all this. I think I said it in the opening statement. We provide all this information as learning tools and as your mentor along the way, but then we want you to go on your own and make your own decisions. It's not about saying, well, what did Steve do today, or what is the buy signal, in this stock, or what they're telling us. Don't worry about those things. That's probably why most traders fail, in my opinion. Trust what you've learned, then go find the market and the time frame that makes you feel comfortable, and that's the one you should be trading. Okay. Nick says, Steve, for confirmation, you say 1 to 5 ticks above or below the confirmation bar for stocks and the S&P EMini. How many pips would that be in the Forex? 1 to 3 pips? Because I see 2 to 4 ticks to a pip on some platforms. Yes, once again, that's up to you. These rules are not written in stone, but it can be anywhere from 1 to 5 pips. It's up to you. Now, obviously, if you're trading tick charts or a 1-minute bar in the currency pairs, you may not want to, wait for 1 to 5 pips because that'll probably take out most of your profit. because of the structure of the bars. But if you're trading, something a little longer time frame, maybe a 30-minute bar or something, sure, you can use 1 to 5 pips. Okay. Muniraj is asking, is there a live trading session webinar? No, we don't see. Once again, I have had live trading webinars in the past, and I've seen that my students use them as a crutch because just like a chat room, just like a trading room, students see the way we're applying this and then think, okay, well then that's the way I'm supposed to trade. That's the market I'm supposed to trade. That's the time frame. And they use it as a crutch, and then once again, you get to that side of the fence where you're relying on a certain time frame or a certain way in which to trade it. We try to provide you with all the information, see what makes you feel comfortable, work with you on the strategy once you get the basic format, and then we want you to find out what works for you. If you're looking at a live trading presentation, most of my students in the past have said, well, Steve is looking at a 5-minute bar, so I guess I've got to trade a 5. Or we had a couple of winning on a 5-minute bar, so that means I've got to do it. It's a crutch. I don't believe in trading rooms. I don't believe in chat rooms because, once again, most traders will think that that's the way they have to trade. That, in my 38 years, is the easiest way to become a losing trader, to go to chat rooms or trade rooms and listen to what the others are doing. Okay? Get the information, learn how to apply it, and then be your own guide. Listen to what makes you feel comfortable, not what someone in a chat room or trading room is telling you. Okay? You see, most traders don't want to do that. It's too hard of work, but that's why most traders fail. Jimmy's asking me once again, what brokerage do you use for this? You can use any brokerage you want. Once again, we're not affiliated with anyone. If you're asking about what trading platforms, okay, here are the platforms that the PET-D and Strategy 4 work along with. They work on NinjaTrader, Metastock, MT4, TradeStation, FCXM, Sierra Charts, and you can also apply it to Thinkorswim, but because of the way Thinkorswim is set up, we can't actually apply our indicators and the PET-D on their actual charts. So what we do is we can use the data, for stock trading that comes with Thinkorswim, and then we give you a free NinjaTrader platform. Doesn't cost anything, and you can see all of our indicators on that. Now, you can have both running at the same time. Here's the good news. We have a great tech support department. They set all that up for you. So all you have to do is just call them up, and they can put it all together for you, and you'll be up and running in a matter of moments looking at the PET-D and Strategy 4. Okay? Nick says, do you need the PET-D with the Strategy 4, or can you do well with just the Strategy number 4? Sure, you can do well with Strategy 4. It has a certain level of consistency, but trust me, I believe that one of our students named Strategy 4 and the PET-D the dynamic duo because that's how well it works. We have a student in India that does so well using the dynamic duo, and once again, I'm not saying that this can happen, but he even told me that he was saving so much money, he was considering buying a home with the money he was making by using the dynamic duo. So I really feel it gives you that added level of consistency. So if I chose anything, I personally would choose the dynamic duo. Strategy 4 is good. I'm not telling you it's not, but working together with the PET-D, I mean, you're really increasing your odds for success, okay? And remember, I'm there with you every step of the way. A lot of people are saying, thank you, you're welcome. Now remember, as I stated, most traders start out the beginning of the year. I know I used to do this. They start at the beginning of the year with all these hopes and aspirations of how they want to conclude. Maybe you want to take that dream vacation. Maybe you want that added room on your, or addition onto your house. Maybe you want to start a full career and you're hoping that by the end of the year, you'll be able to sustain yourself and quit your job, okay? And I can honestly say the majority of traders fall well short of that. They never get to that level, okay? So the point is, why is that? The reason is we're basing our trades off of what someone or something else is telling us what to do. First we had Lorek or someone asking me, what time frame do you trade? What about stop losses? Why do the guys, the specialists, run the stop losses? You're taking your cue from outside sources. Don't worry about those things. Worry about what the market is telling you. The market is telling you what it wants to do, okay? Our job as traders is to learn how to listen what the market wants to do and to jump on board. The good news is that specialist trading provides you with that education for both. We show you how to listen to what the market is doing. We don't show you how to figure out what the news is. We don't show you how to figure out what someone is saying in a chat room or a trading room. We don't show you how to figure out what a particular indicator means. It's too complicated and too subjective. We just show you how to listen to what the market is telling you. And then we give you structure so that you can jump on board. It's that easy, but everyone wants to overcomplicate your trading. As I've tweeted before, it is the easiest thing in the world to overcomplicate your trading. If you've been trading for 30 years or you've been trading for 30 minutes, it doesn't matter. Anyone can pile on as many rules and as many requirements on a trading plan as they want and make it complicated. But guess what? That's not going to make you any more successful. In fact, in my 38 years, I found out that it does the opposite. That actually makes you less successful. What makes you more consistent is stripping away and simplifying your trading plan. There's a lot more character. It's a lot more difficult to do that. But once you do, that's when you get on that road to consistency. That is what specialist trading is all about. That's what I teach. That's what I mentor. And that's why I'm there with you every step of the way to make sure that you're keeping things simple. So that's what we do. We try to simplify your trading, and we're there with you every step of the way. We've come out to the end of our time here, but if you're really serious about taking your trading to the next level in 2016 so that you can do all those things you've promised yourself for years, well, here's your last chance, okay? These prices are going to go up. We're giving you a great deal right now, plus you're getting 38 years of experience along with that. If you're interested, call up Pro Trader Strategies. They'll help you set up everything. They'll help you decide what payment plan you want, and they'll work with you in the tech support department so that you can be up and running as soon as possible. Okay? In conclusion, I want to thank you so much for attending today, and I really, truly, honestly hope that you do well in 2016, and I really hope that you take advantage of this offer so that you can become a student of mine. Okay? Thank you so much. I'll see you next time. Bye-bye.